Good day, class. Now we are on the chapter 3 of our lesson in taxation. We will deal with taxation principles, doctrines, and theories. Principles, doctrines, and theories are distinct concepts in the context of taxation and other fields. Here's how they differ. Principles are fundamental guidelines or fundamental truths that form the foundation of a subject or field. In taxation, principles are fundamental concepts that guide the design, implementation, and evaluation of tax systems. They serve as the overarching framework for tax policies and objectives. Examples of taxation principles include equity, efficiency, simplicity, certainty, neutrality, and transparency. Doctrines are established principles or beliefs that have been developed through legal precedents, court decisions, or administrative practices. In taxation, doctrines are specific legal rules or interpretations that the tax authorities or courts use to apply tax laws to specific situations or cases. Taxation doctrines help interpret and apply tax laws and may address specific tax issues or scenarios. Examples of taxation doctrines include the substance over form doctrine, the arm's length principle, and the step in the in the step transaction doctrine. Theories are systematic explanation or hypotheses that aim to explain phenomena or relationships within a specific field. In taxation, theories are academic or economic frameworks that seek to explain the rationale and objectives of taxation and its impact on the economy and society. Taxation theories provide different perspectives on how taxes should be levied, who should bear the tax burden, and what the goals of taxation should be. Examples of taxation theories include the benefit theory, the ability to pay theory, optimal taxation theory, and the fiscal illusion theory. To summarize, principles are fundamental guidelines that underpin a subject. Doctrines are established legal rules or interpretations, and theories are systematic explanations that aim to understand and explain phenomena within a field. In the context of taxation, principles guide tax policies, doctrines interpret tax laws, and theories provide frameworks for understanding the purpose and impact of taxation. What are the established principles of taxation? Taxation principles are fundamental guidelines and concepts that underpin the design and implementation of a fair, efficient, and effective tax system. These principles provide a framework for policymakers and tax authorities to create and administer taxes in a manner that aligns with societal goals, economic objectives, and the principles of good governance. The principles of taxation in the 18th century economist and philosopher Adam Smith attempted to systematize the rules that should govern a rational system of taxation. In The Wealth of Nation, Book 5, Chapter 2, he sat down four general canons. First canon, the subjects of every state ought to contribute towards the support of the government as nearly as possible, it in proportion to their respective abilities, that is, in proportion to the revenue which they respectively enjoy under the protection of the state. Canon number 2, the tax which each individual is bound to pay ought to be certain and not arbitrary. The time of payment, the manner of payment, the quantity to be paid ought to be all clear and plain to the contributor, and to every other person. Every tax, number 3, every tax ought to be levied at the time or in the manner in which it is most likely to be convenient for the contributor to pay it. And canon number 4, every tax ought to be so contrived as to both to take out and keep out of pockets of the people as little possible over and above what it brings into the public's treasury of the state. Taxation involves a careful balancing act between fairness, efficiency, and practicality. Governments must consider various principles and the specific needs and circumstances of their countries to design tax systems that fund public services, promote economic growth, and distribute the tax burden in a way that is perceived as fair by the citizens. We have different principles here. One, we have horizontal equity. The principle of horizontal equity states that individuals or businesses in similar situations should be treated equally in terms of tax liability. This means that if two people have the same income and circumstances, they should pay the same amount of taxes. However, there are cases where certain groups or industries may receive special tax advantages or exemptions, leading to debates about fairness. The second principle is the ability to pay principle. The ability to pay principle focuses on distributing the tax burden based on an individual's or business's capacity to pay. This takes into account factors such as income, wealth, and other relevant personal characteristics. Taxes that align with this principle are often personal levies like income taxes, net worth taxes, consumption taxes, and inheritance taxes. Historically, income has been considered the best indicator of ability to pay, but some argue that consumption-based taxes should could also be fairer. Another principle is the benefit principle. The benefit principle views taxes as a way to fund public services similar to how people pay for goods and services in private transactions. Ideally, taxpayers should pay for the specific public services they benefit from. However, this principle is challenging to implement because many public services, like police protection, benefit everyone collectively, making it hard to link taxes directly to individual benefits. Some taxes, like road user fees or tolls and motor fuel taxes, come closer to, applying the benefit principle by funding specific infrastructure. Another theory is economic efficiency. Tax systems should aim to minimize interference with the functioning of the market economy. This means taxes should avoid favoring or discouraging specific economic activities, consumption choices, industries, or forms of organization. When taxes distort economic decisions, it creates an excess burden, leading to inefficiencies. Economists try to design tax policies that minimize these distortions while still achieving other economic and social objectives. Ease of administration and compliance. Principle. Tax laws should be clear, stable, and easy to understand for both taxpayers and tax administrators. Complex or frequently changing tax laws can lead to errors, non-compliance, and confusion. In developing countries or countries transitioning from different tax systems, administrative challenges can arise due to limited resources, illiteracy, and lack of commercial markets. To encourage compliance, Taxes should be convenient to pay, and taxes may be allowed to pay large and taxpayers rather may be allowed to pay large tax liabilities in installments or have generous time limits for completing returns. Another principle is clarity. Tax laws and regulations should be easy for taxpayers to understand. They should be simple and clear, even though tax policies have other important goals too. Unfortunately, in some countries, tax laws can be quite confusing for the public. This leads to mistakes in tax payments and makes it difficult for people who are less educated or financially disadvantaged to benefit from legal ways to save on taxes. Sometimes, efforts to make the tax system fair can make it more complicated, which defeats the purpose of reform. Another principle is stability. Tax laws should not change too often. When changes are needed, they should be part of a well-planned tax reform with fair and orderly transitions. Frequent changes can cause problems like reduced compliance, where people may try to avoid paying taxes because they expect more changes in the future. For example, if there's going to be a higher tax on alcoholic drinks, people might buy and store a lot of alcohol before the change happens. Another principle, cost effectiveness. It is important to keep the costs of assessing, collecting, and managing taxes as low as possible, while still achieving the other goals of taxation. In developed countries, this is not the biggest concern, but in developing countries, or countries changing from different tax systems, resources for tax administration may be limited. However, it is essential to balance cost with fairness and economic sense. The costs that need to be minimized include government expenses related to tax collection, but also the cost borne by taxpayers and private organizations like employers who help collect taxes on behalf of the government. The principle of convenience. Paying taxes, paying taxes should be as convenient as possible for taxpayers while still following the more important tax principles. Governments often allow people to pay large tax amounts in installments and set generous time limits for submitting tax returns. This way, taxpayers can manage their finances better and have enough time to prepare and submit accurate tax information. Another principle, jurisdiction over subjects and objects. The basis of taxation includes the jurisdiction or authority that a government has over its subjects, individuals and businesses, and objects, income, property, transactions, and others. Taxation is typically imposed based on the following principles: residency, source of income, ownership and transfer of property, consumption, citizenship. So let's take it one by one. Jurisdiction about residents. Most countries tax their residents on their worldwide income, regardless of where it is earned. Non-residents are usually taxed on income derived within the country's borders. Source of income. Some countries tax income based on the location where it is earned or generated. This applies to business income, interest, dividends, and other forms of income. Ownership and transfer of property. Property taxes are often based on the location of the property, while transfer taxes like estate and gift taxes depend on the jurisdiction on of the transferor or the recipient. Consumption. Sales tax and value-added tax are imposed on the consumption of goods and services within a particular jurisdiction. Citizenship. A few countries, such as United States, impose taxes on their citizens' worldwide income, regardless of where they reside. These taxation principles form the foundation of a well-designed tax system and guide policymakers in striking balance between revenue generation and fostering economic growth, while promoting social equity and public welfare. The application of these principles varies across countries and depends on each nation's unique economic, social, and political circumstances. What are the principles of a sound tax system? The principles of a sound tax system are fiscal adequacy, administrative feasibility, and theoretical justice. Fiscal adequacy means the sources of revenue must be sufficient to meet government expenditures and other public needs. Administrative feasibility means the tax laws and regulations must be capable of being effectively enforced with the least inconvenience to the taxpayer. And theoretical justice means that a sound tax system must be based on the taxpayer's ability to pay. Let's take this one by one. Fiscal adequacy. Fiscal adequacy refers to the ability of a tax system to generate enough revenue to cover government expenditures and fulfill public needs. For a government to function effectively, it requires funds to finance various public services and infrastructure projects. These expenditures may include education, healthcare, defense, public safety, infrastructure development, and social welfare programs. A tax system must be structured in such a way that ensures an adequate and stable flow of revenue to meet these financial requirements. This principle involves assessing the government's budgetary needs and setting tax rates and structures accordingly. Failure to achieve fiscal adequacy can lead to budget deficits, reliance on borrowing, or the inability to provide essential public services. Administrative feasibility. What is administrative feasibility? Administrative feasibility focuses on the practicality and efficiency of enforcing tax laws and regulations. A tax system may have well-designed rules, but if it is overly complex or difficult to administer, it can result in low compliance rates and a significant administrative cost. An administratively feasible tax system should be clear, straightforward, and easy for taxpayers to understand and comply with. It should also be manageable for tax authorities to implement and enforce without undue burden or excessive cost. Efficient tax administration ensures that taxes are collected in a timely manner, minimizing tax evasion and fraud. Simplification of tax processes and the use of modern technology can enhance administrative feasibility. Additionally, effective taxpayer education and outreach program can improve voluntary compliance and reduce the need for extensive enforcement measures. The next is theoretical justice or the ability to pay principle. The theoretical justice emphasizes that a sound tax system should be based on taxpayers' ability to shoulder the tax burden. It recognizes that individuals and businesses with lighter incomes or with higher incomes or greater economic capacity should contribute proportionally more to public revenues compared to those with lower incomes. The ability to pay principle promotes vertical equity, aiming to reduce income inequality and distribute the tax burden more fairly. Progressive tax systems, where tax rates increase as income rises, are one way to implement this principle. Such systems ensure that higher income individuals pay a larger share of their income in taxes, while those with lower incomes pay a smaller percentage. By incorporating the ability to pay principal, a tax system can strike a balance between raising necessary revenue and promoting social equity. It considers the varying financial capacities of taxpayers and seeks to minimize the financial burden on those who may already be economically disadvantaged. We go to the doctrines in taxation. So, in the field of taxation, several commonly practiced doctrines have been developed through legal precedents and administrative practices. These doctrines help tax authorities interpret tax laws, address specific tax issues, and ensure the proper application of tax rules. Some of the commonly practiced taxation doctrines include: 1. Substance over form doctrine. This doctrine emphasizes the economic substance and the true nature of a transaction over its legal form. If a transaction's true economic effects differs from its formal structure, tax authorities may reclassify it for tax purposes. Next is business purpose doctrine. The business purpose doctrine requires that a transaction or business engagement must have a legitimate and bona fide business purpose beyond just obtaining tax benefits. Transactions lacking a genuine business purpose may be disregarded for tax purposes. Next is economic substance doctrine. This doctrine is closely related to the substance over form doctrine and focuses on whether transactions have and whether a transaction has economic substance beyond its tax implications. Transactions lacking economic substance may be disallowed for tax purposes. Arm's length principle. What is arm's length principle? The arm's length principle is applied to transactions between related parties. It requires that related parties transact on terms similar to those that would have been agreed upon by unrelated parties in an open market. This principle helps prevent tax avoidance through artificial pricing within related party transactions. Next is step transaction doctrine. Step transaction doctrine treats a series of interconnected transactions as a single transaction for tax purposes. It aims to prevent taxpayers from dividing a single transaction into multiple steps to achieve a more favorable tax outcome. Substance over technicalities doctrine. What is this doctrine? This doctrine allows tax authorities to look beyond the technicalities of transaction and focus on its economic realities when assessing tax implications. Next is beneficial ownership doctrine. The beneficial ownership doctrine determines the proper recipient of income for tax purposes. The beneficial owner of income is the person who is entitled to enjoy the economic benefits of the income and bears the associated risks. Next is sham transaction doctrine. The sham transaction doctrine disregards a transaction that lacks economic substance and is entered into solely to create a tax advantage without any genuine business purpose. Next is constructive ownership doctrine. The constructive ownership doctrine attributes ownership of an asset or income to a taxpayer even if they do not have the legal ownership but have control or certain other interests in the asset. So these doctrines help tax authorities ensure that taxpayers comply with the spirit of tax laws and prevent tax avoidance through artificial transactions or structures. They play a critical role in shaping tax policies and decisions, promoting tax fairness, and maintaining the integrity of the tax system. Our next topic is the theories on taxation. In the field of taxation, several theories have been proposed by economists, scholars, and policymakers to understand the principles and objectives of taxation. These theories provide different perspectives on how taxes should be levied, who should bear the tax burden, and what the goals of taxation should be. Some of the prominent theories in taxation include: number one, lifeblood theory. The lifeblood theory of taxation states that taxes are the life force of a nation's economy. Just as blood sustains the human body, taxes sustain the government and its function. This theory suggests that without adequate revenue through taxation, the government cannot operate effectively and public services would be severely compromised. Proponents of the lifeblood theory argue that taxes are essential for maintaining law and order, providing education, healthcare, and infrastructure, promoting economic growth, and ensuring the overall well-being of society. And without taxation, government would be unable to fulfill their responsibilities, leading to a breakdown of society. Next is necessity theory. The necessity theory of taxation asserts that taxes are necessary to meet the financial needs of the government. According to this theory, taxation is imposed out of practical necessity rather than any moral or philosophical justification. Governments require funds to function, and taxation is the most practical way to raise revenue. The necessity theory recognizes that public goods and services benefit everyone in society, and it is only fair that everyone contributes their share through taxation. It does not rely on the idea of taxes as a form of payment for specific benefits received. Benefits protection theory or symbiotic relationship theory. The benefits protection theory proposes that individuals and businesses should pay taxes in proportion to the benefits provided by the government in return. For example, proponents of this theory argue that property taxes are justified because property owners benefit from services like law enforcement, fire protection, and public infrastructure. Similar to income taxes can be seen as contribution to the benefits received from public services, education, and healthcare. Another theory, ability to pay theory. The ability to pay theory argues that individuals should be taxed according to their ability to pay, which is typically determined by their income or wealth. Progressive taxation, where higher income individuals pay a higher percentage of their income in taxes, is consistent with the ability to pay principle. Horizontal equity, another principle. Horizontal equity refers to the principle that individuals in similar economic circumstances should be treated equally under the tax system. Taxpayers with similar levels of income and economic situations should face similar tax liabilities. Vertical equity. Vertical equity refers to the principle that individuals with different economic circumstances should be treated differently under the tax system. Progressive taxation is an example of vertical equity, where higher income individuals bear a higher tax burden over lower income individuals. Optimal taxation theory. Optimal taxation theory aims to find the tax structure that maximizes social welfare and economic efficiency. It considers the trade-offs between revenue generation and minimizing market distortion caused by taxes. Tax smoothing theory. Tax smoothing theory advocates for stable and predictable tax rates over time to promote economic stability and avoid large fluctuations in tax burdens. Tax incidence theory. Tax incidence theory examines how the burden of taxes is distributed among different economic agents such as consumers, producers, and workers. It analyzes who ultimately bears the economic burden of a tax. Tax elasticity theory. Tax elasticity theory explores how changes in tax rates influence taxpayers' behavior and the resulting impact on tax revenue. It considers the responsiveness of taxpayers to change in tax rates. Taxes or Pigovian theory. Pigovian taxes were named after English economist Arthur Pigou, a significant contributor to early externality theory. Taxes are levied on activities that generate negative externalities such as pollution or harmful behavior to correct market failures. A Pigovian tax is a tax assessed against private individuals or businesses for engaging activities that create adverse effects for society. Adverse side effects are those costs that are not included as part of the product's market price. These include environmental pollutions, strains on public health care from the sale of tobacco products, and any other side effects that have an external negative impact. These theories offer valuable insights for the design and evaluation of tax policies, helping policymakers strike a balance between revenue generation, economic efficiency, and social objectives. Different countries may adopt different combinations of these theories based on their specific economic and social goals. Principles, doctrines, and theories embodied in the 1987 Philippine Constitution. The 1987 Constitution of the Philippines does not explicitly list tax principles, but it provides a framework for taxation and includes certain provisions that reflect important taxation principles. Some of the tax principles embodied in the 1987 Constitution are as follows. Number one is equity and social justice. The preamble of the Constitution emphasizes the pursuit of justice and social order to ensure the welfare of all citizens. This reflects the principle of equity in taxation, which requires that taxes be distributed fairly and proportionately based on the taxpayer's ability to pay. Number two is the uniform and equitable taxation. Article 6, Section 28 of the Constitution mandates that the rule of taxation shall be uniform and equitable. This provision underscores the importance of treating taxpayers fairly and without discrimination based on the economic status or other factors. Third is protection of property rights. Article 3, Section 9 of the Constitution protects the right to property. This principle aligns with a certainty doctrine in taxation, ensuring that individuals' property rights are safeguarded from arbitrary or excessive taxation. Number four, non-impairment of exemptions. Article 6, Section 28 also grants exemptions from taxation for certain to certain entities such as charitable institutions, churches, mosques, and non-profit cemeteries, provided they meet specific criteria. This provision protects the non-impairment doctrine, ensuring that tax exemptions granted to these entities remain valid and enforceable. Fiscal autonomy of local government units. Article 10, Section 6 of the Constitution grants fiscal autonomy to LGUs, or local government units, empowering them to create their sources of revenue, including imposing and collecting taxes, fees, and charges. This principle reflects the benefit theory of taxation, where local taxes are imposed to finance the services and projects that directly benefit the residents of the respective LGUs. Non-discriminatory against charitable institution. Under Article 6, Section 28, subsection 3 of the Constitution, it prohibits the use of charitable institutions, churches, mosques, and nonprofit cemeteries for profit. This provision ensures that these tax-exempt entities are not exploited for commercial gain. Equity and social justice. The Constitution emphasizes the pursuit of equity and social justice in the preamble. This principle is consistent with the ability to pay theory, which advocates for individuals to be taxed based on their ability to pay taxes. Next is protection of property rights. The Constitution safeguards private property rights under Article 3 and Section 9, which aligns with the principle of certainty and stability in taxation, ensuring that individuals' property rights are protected from arbitrary or excessive taxation. Local autonomy. The Constitution grants local government units fiscal autonomy under Article 10, Section 6. This principle reflects the benefit theory of taxation, where local taxes are imposed to finance the services and projects that directly benefit the residents of the respective LGUs. Non-impairment of contracts. The Constitution prohibits the impairment of the obligation of contracts, Article 3, Section 10. This principle aligns with the certainty doctrine in taxation, ensuring that tax laws do not retroactively affect existing contractual agreements. And the last one is accountability of public officers. The Constitution mandates that public officers and employees be held accountable to the public. Article 11, Section 1. This principle supports the transparency and accountability aspects of taxation, ensuring that tax revenues are utilized responsibly and for public's benefit. So this ends our discussion for this topic.